Just like last time, the last couple times, I'm going to take a pulse check of the room, and we're going to be doing like just a brief survey, about 4 questions long, just to see what everybody's really concerned about tonight. And that way we get to gear the conversation, more towards what you want to know about, not just us rambling on around here about whatever, okay? So the first question is, which best describes how you feel about the markets for the second half of 2026? Very optimistic, cautiously optimistic, neutral or unsure, concerned, or very concerned. So who says very optimistic? All right, 2 people, awesome. Cautiously optimistic. Okay, that's good. Neutral or unsure? Okay. Concerned. All right, got a few there. Very concerned. Good, all right, awesome. All right, question 2, biggest investor concern. What concerns you most as we head into the second half of 2026? Market valuations being too high, inflation reaccelerating because of energy prices, interest rates not falling as much as expected, geopolitical or political uncertainty, AI semiconductor concentrations in the market, or I'm not particularly concerned right now. So who says market valuations are too high? Okay, and if you want, you can answer for whatever question you want to. It doesn't have to be like a pick one. Inflation reaccelerating because of energy prices. Okay. Interest rates not falling as much as expected. Okay. Geopolitical or political uncertainty. Quite a few there. AI and semiconductor concentrations in the market. Okay. I'm not particularly concerned right now. Okay. Question 3. How much market volatility do you expect for the rest of 2026? Less than what we saw earlier this year? About the same? More than earlier this year? Or not sure? Okay. So less than what we saw earlier this year. Awesome. About the same. Okay. More than earlier this year. All right. Not sure. All right. Honesty, I love it. Okay. All right. Question 4, AI and technology. How do you currently feel about AI, semiconductors, and technology-related investments? Very excited, interested but cautious, neutral, concerned about hype or crowding, or not something I focus on. Very excited. Okay. Interested but cautious. All right, cool. Neutral. All right. Concerned about hype or crowding. Okay. Not something I focus on. Okay, very good. How's that? That's good stuff. All right, good. All right, moving along. So I want to give you just a quick 1-minute feeling about what we're thinking, okay? And I think Eric will probably agree with probably 99.9% of what I'm about to say. But this is just kind of like our own personal thoughts. You guys came out here tonight. I'm going to have the 2026 mid-year outlook or whatever that we'll be releasing later this month. But just to give you a little bit of a sneak preview. So earlier in the year when we were here in January, the title of our outlook was optimistic but not naive. Right? I was concerned that the valuations were a little bit high, that we were probably going to get a pullback in the market at some point. We do most years, but I was especially this year because it's a midterm election year and there's a bunch of other stuff going on. And we already got a little bit of a pullback back in February, March. Okay. The comeback from that was fairly strong, I would say, right? We lost, we got 2% in January on the upside, lost about 9 from the high, and then roared back something like 19% at the high just a few days ago, okay, from the March lows. So that's good. I mean, the S&P at the end of May was up pretty close to 10%, okay? I mean, good stuff. Can't complain about that. But there is a lot of crowding, in my opinion, in the market, right? There's a lot of names that are associated with AI infrastructure, semiconductors, and just for a couple of fun facts, a particular company like Micron, how many people have heard of Micron over the last few weeks? Wow, I'm actually surprised. I'm actually surprised they've been like all over the news. Okay, so Micron is a company that basically produces memory chips. Okay, a year ago they were a $121 billion company. Okay, anybody want to take a guess what they're worth today? 1.2 trillion is what they were worth at their high just a few days ago. Okay, so for anybody that doesn't feel like doing the math, that's almost 1,000% return in 12 months. Pretty crazy, right? Even further than that. Semiconductors 10 years ago were 2% of the S&P 500. Today, they're about 19% of the S&P 500. Okay, and even crazier than that, they're almost 45% of the technology index, of the technology sector. Okay, so about half of the technology sector right now is made up of semiconductor chips, and that's just semiconductors. I'm not even talking about like computer and server hardware companies. If you add them in, it's way more. Okay. I think there's still some caution signs that are, very real and still ahead. Obviously, we still have military conflicts going on over in Iran. That's a major deal. We're about 100 days into the Strait of Hormuz being effectively closed to regular shipping and energy shipping and things like that. There's been a lot of energy supply disruption that's been going on since late February when all that started. And that's putting some pressure on inflation. Right? And I think that the path to lower rates is unclear, to say the least, right now. We also have some major new companies coming into the public markets, SpaceX, Anthropic, OpenAI, and a bunch of others that are rumored to come out either later this year. And it's also a midterm election year. We haven't even started seeing the ads for that yet, and that's always fun and glorious. And at the same time, the economy's not doing bad at all. We just got finished the first quarter earnings season reports, and the growth from year over year was about 29%. That's like crazy. It hasn't been that much since coming out of 2022. It's huge earnings for companies. Companies are making money hand over fist, with one caveat that about 10 percentage points of that was a lot of tech companies and communication companies' investments in the private companies like OpenAI and Anthropic and things like that. But even still, 19% of real earnings growth is very good. 8 out of 11 sectors of the S&P grew earnings by double digits. Very good. Okay, that's the start of a very healthy economy and healthy market, broadly speaking. The last report that I saw from the Fed, from the Atlanta Fed, is that they're still expecting 3% GDP growth this quarter, year over year. That's a good thing. And unemployment's been holding strong at 4.3%. Okay, so people still have jobs. The last few payroll reports have been really good. The ones from the months previous were revised up. That's a strong sign that companies are still hiring. Okay, so not really much evidence of like AI taking over everybody's jobs yet. From our perspective, what's most important, right? We want to stay diversified, okay, obviously, and we want to stay invested, right? The only way you can really make money is if you're invested in the market, right? So long term, that's what we want to do, okay? And even probably most of all, we want to be selective in the companies which we invest in. And I can't stress how much of importance is to be invested in quality companies, okay? And companies that have real sales, real earnings, real profits, and things like that. I think sometimes we forget that these ticker symbols that we see on the screen or on our phones or whatever, there are actual companies behind those ticker symbols. It can be easy to get a little bit confused and think that like these things are almost like something that we're gambling on, right? But these are companies that we want to be invested for the long term, so we want to make sure that they're quality companies and they're going to be around, for the most part. Okay, so without further ado, I've spoken quite enough. I want to introduce Eric. Eric is the Chief Market Strategist for GVA, for Great Valley Advisor Group. Great Valley Advisor Group not only provides us with compliance, they're our compliance partners, but outside of that, they manage about $12 billion now, somewhere in that? Yeah, $12 billion for other advisors and their clients and things like that. So Eric's a very busy man, so I appreciate him being here. Eric has over 25 years of investment experience, providing economic, market, and investment-related analysis. He's appeared on CNBC, CNN, Money Matters TV, NPR Marketplace, Seeking Alpha, and CFA Magazine. Was an economist at Moody's Analytics, visiting scholar in business and economics at Ursinus College, chartered financial analyst, charter holder, has a master's in finance from Drexel University's LeBeau College of Business, good family man, most important of all, and accomplished marathon runner. I don't know how much marathon running you've been doing recently, as busy as you are, but. All right, so everybody please give Eric a hand for coming up here and going together. Ready?
All set. Looking forward to it.
Any last words?
I agreed with everything you went through just there. So
all right, awesome. Thank you.
This is a good start.
Pat myself on the back. Okay. All right, great. All right, so number one, let's talk about the comeback, okay? So January, just to kind of lay the backdrop a little bit, January, the market was up about 2%. For the month, okay? And they say, as goes January, so goes the year, right? That's a positive thing. January was a positive month. We expect the year to be positive. But starting in February, we had some quite, a sell-off at a lot of software companies, a SaaS apocalypse, so to speak, right? Where a lot of companies were down 40, 50% that people have been making money on for a long time, right? Since then, we've bounced back. And from the lows in March, we've rocketed back about 19% at the high about a week ago or so, and the market was up about 10% as of the end of May. How would you react to all that in like the overall backdrop of the market now, where we are today?
No, it's a great question, and I think the first thing to just reiterate the great points that Ricardo made, and that a number of you agreed with the show of hands. There's a lot to be excited about when it comes to investing in markets right now. As Ricardo mentioned, we have positive GDP growth for the U.S. economy, which, if you think about the things that are going to cause stock prices to go higher, the economy has to be growing, which is one of the core fundamental elements that you need for a higher stock market, is the economy growing. And the economy has continued to defy all expectations over the last few years. We were worried about a recession in 2022, worried about a recession in 2023, in 2024, in 2025, and it never came to pass. We continue to see a strong economy driven by a lot of the things that we're hearing about in the news. Technology spending has been phenomenal. Another key factor is that corporate earnings growth, because you need economic growth in order to provide earnings growth, because earnings growth is what is going to drive stock prices higher. And we're currently projecting, not Ricardo and I, but the market itself is projecting double-digit earnings growth for the S&P 500 over the next 12 to 18 months. So that's a phenomenal backdrop. And to add an additional element here, yes, gasoline prices have been more expensive over the last few months in part because of the conflict in Iran. But inflation expectations, basically what is the market pricing in for inflation expectations on average over the next 5 years? 2.4%, which, having been a macroeconomics professor for 18 years, if you give me 2.5% inflation on average over a 5-year period, I'm going to take that all day long as a stock investor. So the fundamental backdrop here for the markets is very positive. But it doesn't mean that we're not without risks. And we've seen those risks play out a lot already here in 2026. I mean, it's been an amazing year so far. You think about what we did in January. We had the S&P 500. It was a big deal when we crossed 6,000 on the S&P 500. And one of the things that we had been watching for is that, are we going to be able to get above 7,000 on the S&P 500? And we get into January, we get towards late January, and the S&P 500 crawls above the 7,000 level. It gets to 7,002 towards the end of January. And then the correction that Ricardo was talking about began. During the month of February and the month of March, the S&P 500 lost roughly 10% peak to trough. Now, the primary cause is cited to be the conflict in Iran, but the fact of the matter is that the market was in the process of pulling back all during the month of February before that conflict broke out. It was at that point at the end of January, the market was overdue for some sort of consolidation, which is a nice way of saying going down about 5 to 7%. So that was already in motion, and then the conflict in Iran accelerated that. But then we get to the end of March. Now, has the conflict in Iran ended? No, it's still going on. But we got to the end of March. There was some talk about the Strait of Hormuz potentially being reopened. That's all the market needed. March 30th, the market bottomed, and the next thing we know, it is off like a rocket. No future discussion, pun intended. Off like a rocket to the upside during the month of April and the month of May. Going from a market that was down, 7-8% year to date at the end of March to a market that was up double digits by the end of May. That's a phenomenal turnaround. But there are some risks embedded in what we've seen. Market's going up. What could possibly be bad about that? Well, the primary industry within the sector of the market that has driven all of those gains, which Ricardo had talked about in all of the great points that he made, was not only the technology sector, because technology just took off like a rocket ship, but it was the semiconductor industry within the technology sector in particular. Semiconductor stocks were up collectively 75% since the end of March through the end of May. That is tremendous performance, but one of the things that we have to keep in the back of our minds as we go into the second half of the year is that if something can go up 75% in 2 months, it also shares the risk of being able to go down 30, 40, 50% on the flip side. Because markets have a funny way of being symmetrical with themselves. The question is there a catalyst for that to happen in the second half of the year? So it's been an interesting first 5+ months in 2026, and it promises to continue to be interesting and volatile in both directions through the remainder of the year.
Thanks, Eric. All right, so I'm going to move on to earnings and the economy a little bit. One reason why we're still constructive, even though we've seen some volatility and expect a little bit more, is that earnings grew 29%, like I said earlier, year over year. 8 out of 11 sectors of the S&P 500 grew by double digits, and we're still expecting to grow by 3%, year over year this quarter in GDP. How important is that to the market, relative to the returns that we see? How much weight should we put on that as far as fundamentals are concerned?
Okay. Yeah, so a key point that Ricardo says here in terms of 8 out of 11 sectors in the S&P 500 are experiencing double-digit earnings growth. Now, there's one sector that everybody talks about, the technology sector. And for good reason, because we have a transformational change that's taking place in our economy, in our world, and we're seeing it unfold before our very eyes. You flip on your computer, you might have ChatGPT, you might have Claude, you might have Gemini. Artificial intelligence is a complete and total game changer. And this isn't the first time we've seen something transformational like this. We have AI in 2025, 2026. You go back 25 years, you had the advent of the internet, also transformational, 1999, 2000. You had the personal computer back in the mid-1970s. You had the mainframe computer in the 1950s. You had the automobile in the 1920s. You keep going back and back. The railroads, it's just the Industrial Revolution. Every 25 years, you have these massive transformations that take place. But with AI, this is a particularly special one. So the attention on the tech, and the other thing too is tech sector's cool. People love to talk about technology. It's cool stuff. Nobody wants to talk about food stocks. You don't see people line up around the corner for the next can of Campbell's soup that comes out, but they line up for the iPhone because it's cool. And they line up for these technology items because they're transformational. So understandable, tons of attention on the technology sector, and it's been justified because a lot of that earnings growth in the S&P 500 has come from tech. But 8 out of 11 sectors in the S&P 500 are experiencing double-digit earnings growth. That means that there's a bunch of sectors that are in the marketplace right now that nobody's talking about that are doing phenomenally well with their businesses. And one of the things I talk about, things to be excited about as we go through the rest of 2026 and through the remainder of the decade, technology has sucked up all the oxygen. And when I say technology, that includes a couple companies from the communication services industry. It includes a couple companies from the consumer discretionary sector. So you're talking about Tesla, Amazon, Google, Meta, which is Facebook. But there's a lot of other sectors out there that are doing phenomenally well, that aren't getting any attention from investors and really haven't performed all that well because technology's been sucking up all the oxygen. One of the things to be excited about, we saw it back at the turn of the millennium with the bursting of the technology bubble. Technology had a terrible run from 2000 to 2002. It was awful. But there were a lot of sectors in the stock market during that time period that did fantastically well. Healthcare, consumer staples, financials, real estate, all did tremendously well during most of the bursting of the tech bubble. They were up double digits in 2000 and 2001. One of the great things to be excited about this market, if you're in with technology, that's great. There are many other sectors in the S&P 500 right now that are trading at their deepest discounts that we have seen in 40 years that are experiencing this double-digit earnings growth. So even if the tech sector starts to falter and that AI trade doesn't materialize the way that investors are thinking it might, there are a lot of sectors that have the potential to do really, really well. And we have seen that over the last 4 trading days, just as a most recent example. The tech sector has fallen by as much as 12.5% peak to trough over the last 4 trading days since it peaked out on January 3rd. Well, healthcare is up by 7 or 8%. Consumer staples are up about 5%. Financials are up 5%. Real estate's up 4%. There's a lot of areas of the market that are doing well, even though the stock market has hit a bump here over the last few days. And that's just a microcosm of what we could expect to see in the months and the years ahead.
Just a quick follow-up question to that. Do you think that the earnings, it's fantastic earnings, 29% at any time period is fantastic. Do you think that those earnings are sustainable going forward, or is this just kind of like one of those like, oh, okay, we had 1 quarter of great earnings, but it's not sustainable? What do you think about that?
I think it's going to get more challenging, not necessarily for the entire market. I think there's certain sectors that can continue to maintain that healthy earnings growth. Healthcare is one of them. Healthcare, the second fastest growing sector in terms of earnings growth over the last 2 to 3 years, and has had a hard time finding any sustainable love from investors. Those areas have the potential to continue to do well. I do get concerned about the technology sector and their earnings outlook going forward. And the reason for that is because there has been so much euphoria around artificial intelligence over the last few years. What is the primary factor that technology stocks require in order to continue to go higher over time? Strong earnings growth, but just as importantly, if not more so, strong free cash flow growth. They need to be generating tons of free cash flow and at the same time expanding their gross margins, basically making more and more profits and generating massive free cash flow growth. It's the reason why this area of the market has done so well over the last 10 years. But what we have seen take place here over the last 12 months, AI was a huge boom. We had an AI boom that started in the summer of 2023, and it was rocking and rolling for 2 years nonstop, and the party was there for everybody to join in on. But as we got towards the end of 2025, basically what started to happen is that the AI boom transformed into an AI arms race. These mega technology companies and all of the other tech companies that are in and around them, they are spending money like crazy, just depleting that free cash flow. You got a company like Alphabet, which is Google. They issued a century bond, for God's sakes. Whenever I hear anybody, any country or a company issuing a century bond, which means, hey, we're going to pay you back in 100 years for the money we're borrowing for you now. Really? They issued $80 billion of an equity offering to raise money. Meta Platforms, Facebook, $29 billion loan in order to fund a big data center development program. These companies are spending money like crazy, and the reason they're doing it is because they recognize a huge transformation is taking place, and you got to spend in order to win. So they are all spending like crazy because there is going to be winners and losers that are going to be differentiated in this AI arms race that is now unfolded. It's going to take some time for it to play out, but when you're spending like that, that means that your profit margins might start to compress. You might not start to make as much money as you have been. It doesn't mean that's going to happen tomorrow, but as we get through the end of 2026 and into 2027, it's going to be an important thing to monitor. Are these companies able to make the same amount of money that they've been able to make up to this point? And that's going to be a key thing to watch.
All right, so I want to move on to AI. Great subject, quite timely. Like I said earlier, a company like Micron, they basically build two types of memory chips, they're up 187% as of the end of May. It's crazy, right? Just from the beginning of the year till the end of May. Semiconductors, like I said, are up, or they're 19% of the S&P 500. And again, I only stress this, and it may not make a difference to you guys as a whole, but there are semiconductors, right? So like NVIDIA is considered to be a semiconductor company. And then there are computer hardware and server hardware companies. When you split them up in, per industry, as like the S&P does and things like that, that's important, right? And I think it's hugely important to say that semiconductors are 19% of the S&P. When you combine semiconductors and computer hardware, which are companies like Micron, Western Digital, SanDisk, and a few other companies, that's going to make up vastly more. Now, I think those companies are somewhere in the neighborhood of about like 30% or so of the S&P 500 when you add all of those companies, okay? Just to give you an idea, Micron at $1.2 trillion is up there in the top 10 companies of the S&P 500, okay? They're 45% of technology as a whole, okay? How should investors think about the opportunity in AI versus the risk of crowding, okay? I know we've gotten a lot of calls about, investing in this company or in that company. That is in the news a lot, Micron being one of them, Western Digital being another one, SanDisk being another one, ARM being another one. There's a bunch of them that we can list off. Dell popped like crazy last week. HPQ popped for people that don't follow it. HP, Hewlett Packard, that makes like computers. I'm sure probably everybody in this room at one point in their lives have bought a Hewlett Packard computer. They separated years ago into the enterprise version versus like the hardware version. So they popped like crazy last week as well. And any company that has anything to do with anything that has to do with a server has popped over the last few months. So how should we think about that relative to other companies? And you've already kind of like touched on that a little bit, and like relative to the rest of the market. And the only reason why I kind of stress on that is because there are so many times over the years where a lot of investment managers, and not just me, complain about being pegged to the S&P 500, and the S&P 500 is what everybody looks at, or the Dow or whatever. But the S&P 500 today is kind of like what everybody looks at. And when we look at the S&P 500, the makeup of the S&P 500 is not what it was 10 years ago or 5 years ago even, right? The S&P 500 now is probably pretty close, 60% technology or technology related, like Google and Meta and things like that, like you were saying. So like, what are your thoughts on that? How should we position ourselves? Is it more important now that, that we're, looking at under the hood at what we own to make sure that we're owning something that's not necessarily correlated? Or should we just go with the flow?
Yeah, no, it is a great question. We had that chart that Ricardo asked up there in terms of, concerned, very concerned. When you hear that semiconductor stocks are 19% of the S&P 500, that's something to be very concerned about. semiconductor stocks or semiconductor companies, semiconductors, they are right in the middle of this whole AI boom, and I get the excitement. There are certain companies that have certain specialization in terms of the chips that they're making to support this AI boom. But let's get down to the basics. Semiconductors are a commodity. You have companies that are making chips. They are an input. Just like we need copper to build homes, you need semiconductors to build computers and all of these other machines that provide the technology that we all have come to know and love. But they're a commodity. They're an input cost. So they're notoriously volatile. I've been doing this for 30 years. And I was born and raised in a family where I was doing it even longer than that. Ever since I was a little kid, I was exposed to investing. One of the things that I learned at the very start is be careful of semiconductor stocks because they are notoriously volatile. They go through boom and bust cycles. They'll do fantastically well, and they will, figuratively rip your face off to the downside because they're a commodity. They're volatile. Well, we've seen a situation where semiconductor stocks normally trade at a discount to the market. If the market is on an historical average, so I'm going to date myself in terms of my market knowledge, the Graham and Dodd securities analysis. It's like the original textbook for investing in stocks. The average PE ratio on the S&P 500 was supposed to be 15 times earnings. And that has risen over the years now towards like 20 times earnings, justifying those higher valuations. Semiconductor stocks typically trade anywhere to about a 40 to 50% discount to the market. Why? Because they're volatile. Now, that volatility cuts both ways. Semiconductor stocks up 75% since the end of March. Fabulous. Well, here's the only issue with that. There's a lot of really smart people out there who track the markets. And they're doing this every single day. Let's go back to late last year, for example. We get to around Christmas time, and then all of a sudden there's like a couple news reports out there saying like, all this AI might replace people who do all of these software programming for computers. And, that news story got banded around for a couple of days. Next thing you know, software company stocks are falling by 10, 20, 30, 40, 50%. And it's across the board, all these software companies. Are you kidding me? Are you telling me that there's not really smart institutional investors out there who have been monitoring this AI boom for the last 2.5 years, 3 years, and all of a sudden they woke up one day and they're just like, this is going to hurt the software companies? No. The market is an emotional creature, and this is a really emotional space right now with what's going on with this AI boom. Software stocks got absolutely obliterated for like 3 months, and funny enough, they've been making their way back ever since. They're still down from where they were a couple months ago, but they've been making their way back because the realization is that no, not every software company is going to go out of business because of AI. They might actually innovate and figure out how to continue for the next 25 years in some new fashion. Same thing going on with semiconductor stocks. You cannot tell me that institutions were sitting there at the end of March and then all of a sudden something so transformational took place with chip stocks that you could justify a 75% gain in 2 months' time. No, everybody's known what's going on in the AI space, and yes, it's moving fast, but people are on this every single day. If something has gone up 75% to now make up 19% of the S&P 500, be really careful because they are notoriously volatile. Sentiment changes on these semiconductor stocks. The only other sector that industry I would say is comparable is the biotech sector in healthcare. I remember in 2014, biotech stocks were doing the same type of thing. And I wrote an article about how be careful out there with biotech stocks. And people got into the content section or the comment section of my article, and they eviscerated me. They're just like, you don't understand, Parnell, because biotech's going to change the world. Look at all this cool technology. I never said in the article that the biotech companies weren't doing really cool things with the technology of what they're doing in the healthcare sector. I was just saying that the stocks have gotten way too far ahead of themselves. And over the next 2 years, they proceeded to fall precipitously because they had gotten too far ahead of themselves. Same thing with chip stocks today. Be careful out there because it's gotten dangerous.
All right. Thank you so much. Okay, so I'm going to move on to your most favorite subject, inflation.
Oh, yeah? Love inflation.
All right, so technically geopolitics, energy, inflation, the Fed, all of that combined, okay? So one of the caution signs that we're looking at is what's going on with the conflict in Iran, okay? There's a lot of disruption around energy, a lot of disruption around the derivatives of those energy things like natural gas, like fertilizer, all of these things. There's supply disruptions in diesel, there's supply disruptions in jet fuel. They're saying that if things don't, get better in the Middle East, in Iran and stuff, that California might run out of, diesel fuel by the time August rolls around, I think is what I saw. So all of that obviously can put pressure on inflation, okay? So what risks stand out to you the most with that backdrop, as far as like the macro environment right now?
Yeah, so one of the things that I've said, if you've seen me in the past at these events, and it's great to be back here, and there's a lot of familiar faces around the room, so it's great to be back here again. One of the things that I've cited, and it's like a broken record, I'm like Chicken Little up here, I'm going to say the primary downside risk to financial markets is a renewed rise in inflation. We got a bear market in 2022 because we had an inflation outbreak. We had 40 years from 1981 to 2022 where inflation pressures steadily dropped, and very gradually but steadily dropped. And we had the longest bull market in bonds in history, 40-year bull market in bonds, because we went from a 10-year treasury yield, because if corporate earnings growth is the primary driver of stock market returns over time, inflation is the primary driver of bond market returns over time. So we had this massive inflation problem that broke out in this country from 1968 to 1981, 1982, which caused bond yields, the 10-year treasury yield. It was crazy. When I first started out running my own advisory, you would run into these clients that had 30-year treasury bonds that were yielding like 19%. I'd love to have one of those today. But basically, that's the environment we were working in 1981. And for 40 years, we basically didn't have an inflation problem. If anything, we were fighting a deflation problem. That was the financial crisis in 2007 to 2009, was to try to ward off a deflation problem, because deflation is worse than inflation. Deflation is like Great Depression kind of stuff, and I'll spare the reasons why. But since 2022, and the marker that I always like to put on it was when Russia invaded the Ukraine, that basically lit the fire on the inflation era that we are now continuing in. We're 4 years on, and that's going to be the biggest risk to watch going forward. Basically, the era of disinflation, which was aided and supported by globalization, because, hey, the Cold War is over in 1991. And we're going to invite China into the World Trade Organization, and everybody in the world's going to get along, and we're going to, maximize the production possibilities frontier so that we can have the cheapest goods made anywhere in the world, and we'll all share because we all get along, right? Except we don't. Because here we are in 2026, and we are moving to a world of spheres of influence. And there's three primary spheres. There's the United States sphere, there's the China sphere, and there's the Russia sphere. And when you have spheres of influence, that means that you're not able to trade the cheapest goods being manufactured anywhere in the world with everybody else. You have to lean on higher costs of production. And if you have geopolitical conflict break out, like we've seen in the Middle East, and one of the things that we always forget as Americans, or maybe as Russians in the 1970s, if you get into a conflict in the Middle East, man, it's hard to get out of it. Because one of the things that they always like to say in that part of the world is that the Americans may have the weapons, but we got the watches, and we can wait them out. And that's one of the things that we got to be careful of with the situation in Iran. We have seen oil prices go above $100 a barrel. And we've been there before. From 2010 to 2014, oil was consistently above $100 a barrel, and the markets did just fine. But if we start to enter into a situation where this conflict starts to expand on itself, and we see oil prices start to get up to $150 a barrel or $200 a barrel, then you're talking about factors that are not only inflationary, but if you're talking about consumers who are going to the gas station and instead of paying $4.50 a gallon or $5.50 a gallon at the gas pump, now all of a sudden they're paying $8, $9, $10, $11 a gallon for gas. That's the type of thing that recessions are made of, because it hurts consumer confidence. And it's inflationary at the same time. It is an echo of the 1970s, potentially looming out there in the future. It's something that we have to watch as a key downside risk. And the markets, the stock market, we already talked about the bond market, the stock market won't like that at all. So that's something we really need to keep an eye on here as we go through the rest of the year and into the rest of the decade.
All right, so let's say if.
Yeah, that's an if. So
if inflation accelerates, right? If the Iran thing keeps going on and on, if there's problems with supply of fuel, and all of a sudden there's lines at the diesel stations in California, and jet fuel runs out in Europe, and all that stuff. What asset classes or sectors do you think are the safest places to, like, quote unquote, hide?
Absolutely. So, and the first thing, because Ricardo said if, and I just want to reiterate if, because as we look at the market right now, I say primary downside risk to watch out for is a renewed rise in inflation. If you want to monitor this at home, and I encourage you to do so, all you need to do is go onto your computer, and you don't even need your fancy new AI chatbot to tell you to do this. You can go to a good old-fashioned Google, and you go there and you type in 5-year break-even inflation rate. So 5-year break-even inflation rate. It's going to take you to a website called the St. Louis Fred database. And it'll take you to a chart.
Love Fred.
I love Fred. Yeah, it's good stuff. It'll take you to a chart that will give you a real-time indicator, not of what inflation is today. Because, yeah, we saw the inflation number today. It was headline inflation, 4.2%. The number looks hot. I follow it because it's a monthly reading. But I'm following that 5-year break-even inflation rate every day, because it's telling you what is the average expected inflation for the next 5 years. When the situation in Iran broke out back at the end of February, before we had the spike in gasoline prices, the 5-year break-even inflation rate was around 2.4%. Well, here we are 3 months later, and we're seeing higher prices at the gas pump. What's the 5-year break-even inflation rate, expected average inflation over the next 5 years? 2.4%. Basically and this is priced by the market. This isn't a bunch of, economists like myself sitting around and, like, scratching my chin saying, like, wow, what's inflation going to be? This is what the market is pricing in. It's, and there's a mechanism in the market where the market is basically pricing what it thinks inflation is going to be over the next 5 years. 2.4%. So what the market is telling you is that despite all of this geopolitical uncertainty, and despite people like me standing up here and like, worry about the potential for inflation, the market's not worried about it. And I would listen to the market over listening to me, because the market prices truth. And particularly when it comes to bond prices, the bond market's a lot smarter than the stock market over time. So that's where those prices come, is from the bond market. But let's just say we do get a renewed rise in inflation. One of the things that is easy to overlook, we hear about the 1970s. Many of us lived through the 1970s and remember those times well, when going to the bank and you could get 10%, 14% interest on your savings account. And, prices at the gas pump were going higher. And, we hear about the stagflationary 1970s. Well, there's a lot of areas of the market that did fantastically well during the 1970s. I think about my dad, who worked as a director of finance at DuPont, who was basically at the time, it was one of the 10 largest companies in the world. That company did really well during the 1970s because they were making all of the, energy products and raw materials and everything like that were seeing their prices going up all the time. Energy stocks, If oil prices are high, energy stocks benefit from that. And there's a reason why energy stocks were killing it in the first few months of the Iran conflict, because oil prices were going higher. Other sectors that do well, sectors that have pricing power. Consumer staples. Well, they're staples because they're things that we need in order to live our everyday lives. Food, laundry detergent, soap, health care. Yeah, we need that. We remember during COVID, everybody was getting their paper towels and their toilet paper because you need it. These companies have pricing power. Consumer staples, health care, utilities, real estate. All of those areas of the market, financials can even do well in the right type of environment, depending on how interest rates are doing. There's a lot of areas of the market can do really well. Companies that have pricing power, and the companies that can benefit from the higher prices that are in the marketplace.
So I'm glad you brought up bonds, because it reminded me of something that I wanted to ask you also. So they say that the 2-year bond is a prediction of the Fed rates, okay? So I think the Fed rates right around, correct me if I'm wrong, about 3.5 to 3.75% is the range right now. The 2-year bond, I think, is at 4 and change, okay? So that's basically saying that the bond market thinks that the rates should be higher. But one of the bigger reasons for inflation is oil prices and energy prices, which I don't know how much the Fed can actually do as far as that goes. Oh, and P.S., by the way, a Fed chairman was just appointed that went in there with basically the mandate to say that, like, hey, we're going to start lowering rates. Oh, and P.S., there's a Federal Reserve Board that's there that doesn't really feel like we're reducing interest rates right now. So how do you think that plays into the bond market, and then vis-a-vis the stock market, and how those two things relate? What do you think about that?
Yeah, so it's been interesting. You follow the financial news headlines, and we had that really strong jobs report last Friday because the economy, as Ricardo and I have been talking about, the economy growing plus 3% for this current quarter, and the economic outlook remains strong. We have the strong jobs report for the month of May on Friday, and all of a sudden the market is down, significantly. Tech stocks are down 4%, and the slide has continued into this week. And you turn on the news, and they say, the stock market's down because the strong jobs report, which may mean that the Federal Reserve might not be able to lower interest rates as much as we originally thought, or they might even have to raise interest rates. Gasp, what will we do? But that's not why the market went down. When we hit June 2nd on the markets, we had a move on the S&P 500 from 6,300 at the end of March to 7,600. I had made a forecast when the S&P finally broke above 7,000. I said, hey, we might hit 8,000 on the S&P 500 if all goes well. Maybe, this is a bit optimistic, maybe by May of 2027. Well, we were at 7,600, basically less than 400 points away from that 8,000 target on the S&P 500 at the end of May. That's way, way ahead of itself. Basically, the market went up so far, so fast, so quickly over such a short period of time that by the beginning of June, somebody could have simply sneezed on the floor of the New York Stock Exchange, and the S&P 500 was going to be down 2 or 3%. Like, all the market needed was a reason, and the jobs report was that reason. So the fact of the matter is that the market has been pricing in the fact that we're not going to get any interest rate cuts from the Federal Reserve anytime soon. And instead, the market has increasingly been pricing in. If you go out, so here's another tool that you can use if you want to know what the market is pricing in. If you go out to Google and you type in CME, so it's like Charlie, Marty, Echo. I know M isn't Marty from the military alphabet, but so CME Fed Funds Futures. Or CME Fed Watch tool. Use that one instead. CME Fed Watch tool. It will take you to a website where it will tell you what the market is pricing in for the Fed in interest rates over the next 12 to 15 months. Well, for the last couple months, the market has been telling you that it expects the Fed's going to raise interest rates as much as 1 to 3 quarter-point rate hikes over the next 12 months. The market is expecting that the Fed's going to need to raise interest rates in order to deal with this brewing. It's not a sustained inflation problem, as evidenced by the 5-year break-even inflation rate, but we have an immediate inflation problem that is brewing. And the market is already priced in the fact that, hey, the Fed may need to raise interest rates 1, 2, 3 quarter-point hikes here over the next year. And that's one of the reasons why you've seen the 10-year Treasury yield back up from below 4% a couple months ago to 4.5%, 4.6%. The bond market doesn't like higher interest rates from the Federal Reserve, but it's not anything that's careening wildly out of control either. And I got to be honest with you too, as we sit here in the middle of 2026, if you told me 10 years ago or 5 years ago that I could go into the marketplace when the 10-year Treasury yield was yielding 1% for like 15 years after the financial crisis, if you told me I could go into the marketplace and buy a 10-year Treasury bond that was going to yield me 4.6%, I kind of like clipping that coupon here, given what we had over the 15 years prior to 2022. So the bond market is handling it well. The market prices these things in advance. And, the bond market's been moving in that direction for a while. So, the stock market's kind of been looking past it, and that's where some of the downside risk could come with higher interest rates. But the bond market is adjusting to that. It may not like it as it continues to unfold, but, that's the back and forth of the bond market that we're likely to see here. A neutral outlook for the bond market over the next 12 to 18 months.
All right. I'd like to shift gears just a little bit. So earlier in the year in January, I briefly talked about Dr. Ed Yardeni. I'm sure you know who he is. Dr. Ed Yardeni, he coined a term called the gen-shaped economy. You hear about the K-shaped economy, but he calls it the gen-shaped economy, meaning there's a bunch of baby boomers retiring. They all have 401ks, okay, and IRAs, and actually, I looked this up the other day. There's $18.9 trillion in IRAs now. Did you know that? In 2020, it's 2026, right? 2020 is only 6 years ago. There was $11 trillion. All right, so we've grown by $7 trillion in 6 years, right? Not even 6 years. How important the unemployment is still holding at 4.3%, which is awesome. Recent payroll reports have been fairly strong. They've actually adjusted to the upside the previous months, which is always a good thing to see. Retail sales grew by 5.21%, which for a benchmark, the average is roughly 4.75%. That's like the long-term average, so above average. How are you thinking about the consumer, household balance sheets, credit card delinquencies, things like that? How are those things coming up in your mind, and how to think about the market environment?
Yeah, that's phenomenal growth in terms of capital accumulation for people. 6 years, that's 50%, over 50%, 60% increase in asset values over a 5-year time period. And these are people, it's a good segment of this population is people who are on the brink of retirement. So the question becomes, what are the market effects of something like that, and what are the economic effects of something like that? Well, one of the things that has been true for decades now is the resiliency and the creativity of the U.S. consumer. I mean, there's a reason why capital from all around the world has been trying to get into the U.S. for basically the last 2 decades now, because we are a great destination for capital, and we have consumers in this country who are resilient despite the various challenges that they're confronted with. Now, are we seeing some areas of stress in terms of household balance sheets, maybe some rise in auto loan delinquencies and rise in credit card delinquencies? Sure. But that's part of the normal cycle. But one of the things that the U.S. consumer has demonstrated itself to be time and time again is resilient to the various challenges that are thrown in front of them. That includes everything that we went through with the COVID crisis back in 2020. And sure, there was a lot of fiscal and monetary support to help keep the consumer going during that time period. But the U.S. consumer is tremendously resilient. And there's 2 keys in order to ensure that that resiliency remains going forward. One is, how well are we able to protect that asset-based growth? To go from 11 trillion to 18 trillion, that's a lot of spending power, and that's a lot of capital appreciation power if it's being reinvested into the marketplace that can be compounded going forward. So that's a great base to work from. But how do we protect that? It's not by piling all that money into semiconductor stocks necessarily, although it's done really well. How well are we able to protect that base and continue to grow on that base? But the other, which is the more important, is the access to capital. It's the liquidity. One of the ways that the U.S. consumer has been able to be so resilient and be so creative is because the U.S. financial marketplace has afforded the consumer the ability to have that creativity, to have the access to capital. So when they go to the bank to get a credit card or an auto loan or a college education loan or a mortgage, that they're able to get access to that liquidity and that capital in order to support their spending. Now, higher interest rates don't help with that. That restrains the access to capital. If we have some sort of episode that takes place that causes banks to reduce or increase their lending standards and reduce their lending activity to consumers, that's the type of thing that will cause some pressure. But U.S. consumer balance sheets and the U.S. consumer creativity is something that the environment's fostering it, and we continue to see that be a plus, and reasonable to think that that will continue to take place, barring some shock to the system.
Yeah, there's a few companies that you guys can follow if you're ever interested, that if you're wondering how the consumer is doing, Bank of America is one of them. They have a pretty wide range of people that they serve, from lower income to higher income. Visa, MasterCard, Capital One. I think those were probably the companies that are probably best to follow if you're curious of how how the consumer is doing, because they just serve such a wide range of customers. Okay, I want to move on to IPOs. Okay, I know you're not necessarily a stock guy, you're more of a macro market guy, economist, but I also know that these things tend to move markets as a whole, so I'm assuming that you have some kind of opinion on this. If you haven't heard, there are a few companies that are going public this year.
What?
There's one going public in about 2 days, SpaceX, okay? They're going to have a $1.75 trillion market cap as of the IPO price, okay? Last I read, which was this morning, they're oversubscribed for about 4 times. Meaning, if let's say you put your name in, you're an institutional investor and you put your name in and you wanted to buy 100 shares, you'll be lucky to get 25, okay? And from this same source that I read this morning, where I get information from, they're thinking maybe by Friday, when they actually go public, it's going to be 8 times oversubscribed, because there's still a couple more days where people can put in their subscription for SpaceX. They're trying to raise $75 million, okay? SpaceX is only putting about 7% of their company out towards the public market. The public float is going to be only about 7% of the market. Our boy Elon Musk is going to have about 85% of the voting rights for SpaceX. Later in the year, Anthropic is going public, which is responsible for their AI platform, Claude. Yes, thank you. And OpenAI is going public, which is responsible for ChatGPT. Okay, and OpenAI is going to be about a $900 billion company as of right now. Anthropic's to be about $900 billion. OpenAI about $850 billion, and that can change between now and then. This is just estimates as of today. Google, as you mentioned earlier, they did the Century Bond. Well, guess what? They also did a secondary for equity. They've already raised about $40 billion, I think, this year, and I think they're about to raise another $45 billion is what the word on the street is, so to speak. Okay, and they're a $4.4 trillion company as of today. There's also some rumors that Facebook, Meta, is going to do a secondary equity offering also. So there's a lot of new companies or secondaries that are coming onto the market that are going to, for lack of a better word, suck liquidity out of the market, okay? How do you think that's going to affect the market overall, Personally, I think some of the volatility that we've seen this week may be related to the SpaceX IPO coming on Friday. But how do you think about that overall? How it can affect the markets? You lived through, the tech, bubble and all of those companies coming public and how that affected the market overall as well. I remember Alibaba going public. I've been around for a little bit, and that affected some of the markets. Saudi Aramco going public, that was a huge IPO also. But we're talking about just between what's already been announced with Google, SpaceX, Anthropic, and OpenAI, about $335 billion getting ready to put to work as of the IPO price. That doesn't even count afterwards. So opinions on that?
Yeah, so a lot of exciting IPOs. You think of SpaceX. Man, the stuff they talk about doing sounds really cool. A base on Mars that 1 million people are supposedly going to live in. That's a big base. Be very careful out there if you're thinking about doing anything in and around any of these IPOs. I'm sure many of you remember the late 1990s and the IPO wave that Ricardo had mentioned with all the dot-com stocks. And I mean, it was a party for a while until that party ended really badly. And I'm not saying that's going to happen with SpaceX or OpenAI or Anthropic. I've been doing this for a long time, and one of the rules that I've always had when it's come to, from a personal investing rule, is that when a company IPOs, I will wait a minimum of 6 months, if not a full year, before I'll consider buying that company. And the reason that is, whether it could be the greatest company in the world, or it could be an absolute dog. The pricing for companies in the first 6 months to a year after their IPO can be notoriously volatile. And more often than not, it ends up being a wash. There's some companies that get washed out after their IPO. There's some companies that do really well. But there's not like you could sit down and put together a fundamental model to say, okay, well, here are the companies that do really well post-IPO. Here are the companies that do lousy post-IPO. There's a lot of randomness that takes place when you're talking about companies IPOing into the marketplace. And that's a normal IPO environment. And these companies that are about to IPO, this is nothing normal. I remember there used to be a time where people would talk about, I want to find the next Amazon.com in the small cap area of the market so that I can see it go from a $50 million market cap company to be a $1 trillion market cap company. Well, that doesn't exist anymore. Because all of these companies that used to grow from small cap companies to mid cap companies to large cap companies to biggest companies in the world like Microsoft and Apple, and they are all in the private markets now. You hear about private equity and private credit. These companies aren't even in the marketplace until all of a sudden they're like an S&P 10 company and like, boom, we're $2 trillion coming into the marketplace today. Well, there's an issue associated with that we're going to be testing here over the next few months, starting Friday. That's a lot. Ricardo mentioned like $335 billion that you mentioned?
Of actually equity being raised, yeah.
That's a lot of oxygen. Basically, this is not all cash from the sidelines that's going to come into the marketplace to buy up $335 billion worth of capital to be deployed in these companies. It's going to be reallocated from other places. One of the things that we're going to watch, and this is untested, we can only theorize how this is going to play out, but capital is going to have to come from other stocks that are being invested in or other places being invested in the market in order to be deployed to allocate to these new mega cap companies that are coming into the marketplace. That's the first thing. So there's going to be an oxygen redistribution that's going to be taking place in capital markets over the next few months, and it's going to be interesting to see how that plays out. But that capital is going to have to come from somewhere. And as Ricardo mentioned, likely some of the volatility that we've been seeing recently is the market kind of getting ready for this big rock to be dropped into the pond, and it's going to have ripple effects as the IPO plays itself out. There's another factor associated with this SpaceX IPO in particular that really gives me pause. We have rules in place for a reason. There's a reason why major market indices, like the S&P 500, like the NASDAQ 100, they have a wait period. They say, hey, when a company IPOs, we're going to let this whole process play itself out because we know that it's notoriously random. Before we start to put these companies into these indices that everybody and my dog at home are invested in every single day in their investment portfolios and their 401ks and their pension plans. Well, not so for SpaceX. We're getting an exemption here because we're so big, and I get it. It's going to be a huge company, so I get it, like the idea behind it. But I don't like it that we're going to suspend rules here because the company is just so big. Never mind the fact that it's going to be trading at 95 times sales, not earnings. 95 times earnings is really expensive. 95 times sales. And it's not like they're manufacturing these essential chips in order to power the AI revolution. We're talking about a company, yeah, they do a lot of cool stuff, and Starlink, and we're talking about moon bases on Mars. And I'm not saying that as a pejorative. I'm saying this is more speculative. Like, what is their future revenue stream? What is their sustainable earnings stream? What is their free cash flow generation going to be like going forward? That's pretty tough to model because they're in innovative areas, and it is cool stuff. Don't get me wrong. But we're talking about financial modeling and what's the earnings that are going to be generated in order to do this. So the fact that we're seeing these rules suspended, not to mention the fact that SpaceX is arguably the most widely publicly held company that is still yet to IPO that I have ever seen. Like all these mutual funds and ETFs have like, oh, well, we own 20% of our fund in SpaceX, even though it hasn't IPO'd yet. It's still private. And a lot of the people who currently own it, talk about rule changes, they have an exemption, so when the company IPOs, they don't have to, there's usually a lockup period of 6 months when a company IPOs where certain holders can't sell. Well, there's all these exemptions around that where people don't have to wait that 60-day period or that 6-month period. Well, what's going to be the effects of that? Will it be positive? Maybe. We could see SpaceX quadruple in price 10 days. And if it does, fantastic. And kudos to everybody who's on board with that. But we don't know what's going to happen. And it's going to set the tone how this plays out for the expectations around the OpenAI IPO, the Anthropic IPO. We're heading into some uncharted waters here, and it's going to be a source of volatility, if nothing else.
So I want to throw a little bit even more on top of that. So I was reading this morning. I'm going to get really wacky technical here for a second, and I just so you guys can appreciate this for what it is. So I kind of mentioned that that Elon Musk is going to have 85% of the voting rights for SpaceX. Okay, so he basically controls SpaceX, no matter how many people here own stocks of SpaceX when it goes public. Because it's such a high regulatory risk because of that, okay, when one person has so much voting power over one company, and because they're only offering about 7% of the company as far as a public float, so out of 100% of the company, the public is only, they're only offering 7% of it to the public, okay? The NASDAQ and the Russell are making special provisions for them. So as I read up to this morning, the S&P is saying, no go, you're not getting inside the S&P, you still have to follow the regular rules. Great. The NASDAQ and the Russell are making special provisions for them where the NASDAQ is saying, you're going to have to go into a special bucket over the first 6 months while they have the lockup period, and they're only going to be about 1% of the NASDAQ. Okay, no big deal, right? So as of Friday, they're going to be 1% of the NASDAQ. It is what it is. Maybe more depending on how much the stock price goes up. Okay, great. 6 months later, when the lockup period is over, they're going to be market weight, right? Okay, so that means that Friday they're going to be about 1%, let's say, of the NASDAQ. 6 months from now, they're going to be about 9% of the NASDAQ. Okay, so it's kind of like a twofer, right? We're going to have some volatility going on now, people making room to be able to buy into the SpaceX IPO, fund managers, ETF managers, index, shadow index followers, things like that. And then in a few months' time, we're going to have a whole other cycle, right? Where now all of a sudden anybody that pegs themselves to the NASDAQ is going to have to be able to buy potentially 9%, potentially more of their fund inside SpaceX. Okay, super. I see your face. You're like, what the heck? So it's super crazy. Okay, never has this been tested in the marketplace. Okay, so that makes for kind of like a tricky time in the market. How everybody's going to free up cash to be able to do that, because obviously there's not, these fund managers don't have enough cash sitting on the sidelines to be able to buy these things. Okay, great. The Russell is going to do a float-based at first, and then do kind of like a halfy-halfy afterwards, where they're going to go from basically a fraction of a percent of the Russell 3000, and then I think they're going to go up to like about 1 or 2% of the Russell after that. Okay, so that's going to be a huge thing. Okay, that could be good for SpaceX holders, and it could be negative for the market, or it could be positive for the market just because of the kind of like influx of cash. There is trillions of dollars of cash sitting on the sidelines right now, so there is some money to absorb it. So I don't want to like sit up here and be like, oh, it's it's going to create like all this havoc, and God only knows what's going to happen. There is a lot of cash sitting on the sidelines. So it's an unknowable thing that's going to happen between now and then. And obviously we still have OpenAI, Anthropic, Databricks, Stripe, Anduril, a bunch of other companies that want to go public now while the market's in a high. I wouldn't be surprised if Meta does another secondary. I wouldn't be surprised if Oracle does another secondary. Hey, why not Microsoft? Why not all of these other companies that have to raise cash over the next year or two to build up this infrastructure? So just be careful. Okay, I had one more question. I'm going to skip it. I want to open up to the room for questions. I want to hear from you guys. Don't be afraid. There's no such thing as like an insignificant question. Anything that you guys have on your mind, whether it's midterm elections, we didn't even get into that, the IPOs, inflation, the war, if we don't know the answer, we'll just make it up. Who's up first? Go ahead, Mike.
National debt approaching $30 trillion. Current administration was one of the big drivers of it in the last 10 years. Never. Who cares?
Okay, so let me repeat the question. So Mike asked the national debt, 30 trillion of national debt, getting higher, who cares? Right?
I read a piece where the daily interest on that debt is millions. Daily.
So let me add to that just a little bit. No, I want to add to it for you. Make your question a little bit more complicated. So not only do we have $30 trillion of national debt only growing higher, but the strategy of the administration up until this point, and the previous administration as well, was to invest in short-term treasury bonds, to issue short-term treasury bonds to keep that debt down. And now, like I said, like at the 2 years, like above 4%. It's like 4.13 or something like that. Okay, go.
Yeah, so it's the national debt. So one of the first things to remember with the national debt is that the number has gone up a lot. I can remember when I first started teaching 20 plus years ago, and the national debt was like in the $5 to $8 trillion range, and there was a lot of concern about that because, like, oh my God, it's the national debt as a percentage of GDP. So it's kind of like a relative number. How much debt do we have relative to the size of the economy? And the US, GDP in this country has also increased a lot from below 10 trillion to above 20 trillion, 25, 27 trillion dollar economy here today. So it's the percentage of debt relative to GDP is something that's important to note. And one of the things that has been true for the U.S. economy, and it's not just the U.S., we've seen this in a lot of countries around the world, is that they have increasingly taken on more debt relative to their GDP over time. You know, it used to be a key threshold to stay below is about 80% of debt to GDP. You know, you didn't want to borrow up, you know, beyond it's kind of like loan to value on your house. You say, hey, I don't want to borrow up to 80, I don't want to borrow more than 80% on my house because I want to have some equity value. The same principles kind of apply there for an economy. Well, one of the things that we have seen over the last 10 years is that our debt to GDP ratio has gone above 100%. And we, along with a lot of other economies around the world, have been able to get away with that because interest rates have been so low for so long. I mean, you think back 10 years ago, we had economies around the world that had negative interest rates. Check it. You go to borrow money from your government, and they're just like, hey, we're going to pay you to borrow money from us. Okay, I'll do that. That's how ridiculous the interest rate environment had come, and it encouraged a mindset among countries to say, yeah, we can borrow money, and there doesn't seem to be any consequence for it. And, you know, if we need a buyer for our debt, well, we'll dial up the Mariner Eccles building, call up the Federal Reserve, and they can buy the debt, you know, and basically, you know, monetize the debt. And you can do that in a disinflationary environment where interest rates are chronically falling and they're at 1% or 0%. It's a lot harder to do that in an interest rate environment where the Fed funds rate's 3.5% and rising. The national debt doesn't matter until it matters a lot. And when does it start to matter a lot? It starts to matter a lot when interest rates are rising, and, you know, as Ricardo mentioned, hey, we're rolling the debt every 3 months. Well, God, this is starting to get a lot more expensive at 3.5%, 4%, 5%, 6%, 7%, 1981, 20%. All of a sudden, those tax revenues that you're taking in to run your government and to run your country, a lot of that, more and more of that starts to go out the door to pay for interest expense on your debt. Well, if more and more of that's going out to pay interest expense on the debt, you think about the GDP equation, the primary element that is important to make stock prices go up. C plus I plus G plus X sub N. Consumer spending, the C, 70%. Business spending, the I, that's like, 12% or so, 15%. And then you got that G component of GDP. If the U.S. government has to spend more and more of their money on servicing the debt, interest expense, that means that there's less money that they're funneling into the economy to make it grow. And there's another factor that goes in there too, is to say, okay, God, we need revenues in order to support spending, in order to stimulate the economy, which you don't want to do as much of if you have higher inflation. Well, basically, if you're counting on the ability to do that by the Federal Reserve lowering interest rates, and you have an inflation problem where the Fed actually has to raise interest rates as opposed to lower interest rates, you still need to come up with revenue. Where are you going to do it? Something that people in Washington, you find me a politician in Washington that talks about raising taxes on either side of the political aisle, I will show you a snow leopard that's white that lives in my house that is an endangered species, because they don't exist. Put politicians in a spot where all of a sudden they have to start talking about raising taxes again for the first time since George H.W. Bush. That's going to be really interesting to see how that plays out. And that is the environment that we are navigating ourselves into. It's not a today problem, but let's see where we are come 2030, come 2035, when Social Security is also underwater, and we have more and more people from the baby boomer generation that are reliant on Medicare in order to support their health care during retirement, as well as, hey, if we're moving into a world of spheres of influence, we might need to spend a lot on national defense as well. It's going to be interesting to see how that all plays out.
I thought you were going to say you had a white cheetah sitting in your yard.
Allegedly.
Don't play poker with it. All right, next question. Anybody else have a question? What's on your mind? Go ahead.
Eric, the federal sectors are doing well. What
Okay, so many sectors doing well. What sectors are not doing well? Okay, go ahead, Eric.
No, it's a great question. So, a sector that has not done well for a very long time, relative to how it's historically performed, is the consumer staples sector. Getting outside of AI, if we removed AI from the world and we say, okay, what's the hottest thing in the market right now? And if you turn on your television sets and you see people from Hollywood, that's a good hint of what's really big right now. It starts with G and ends with LP1. One of the biggest things, Eli Lilly, Novo Nordisk, you have the healthcare sector that has otherwise been doing lousy relative to the market for the last several years. The second fastest growing sector in the US stock market for the last several years, and was effectively in a bear market through the middle of 2025, despite that plus 20% earnings growth on a sector basis. But the one area of the healthcare sector that's been doing really well has been the GLP-1s, Ozempic, the weight loss drugs. Or they're not intended to be weight loss drugs, but they have evolved to effectively become weight loss drugs. Well, an area of the market that has not done well relatively for years is the consumer staples sector. Because the consumer staples sector, a primary component of that is the food companies. And one of the things that's really come under the microscope for many years now is packaged foods. Food dyes and additives and preservatives, and people emphasizing the perimeter of the grocery store, buying fresh, buying organic. Consumer staples historically has made up anywhere between 10 to 12% of the S&P 500. Today it makes up about 6% of the S&P 500. So it has really struggled on a relative basis. That could imply that there's a great relative value opportunity associated with those companies. Other areas that have struggled, the financial sector has kind of been a boom bust. It really struggled in the aftermath of the financial crisis, the same way the tech sector struggled in the wake of the bursting of the tech bubble. It's done better. It's had its spurts of performance more recently. Another sector that did horribly for years, has picked up the pace in 2022, kind of fell back, had a great start to the year, but has also fallen back, is the energy sector. The energy sector, all through the 2010s, had a decent run in the 2000s, but all through the 2010s was just chronically the worst performing sector on average. Has done well more recently. But if we are indeed heading into an inflationary environment over the next 10 to 15 years, there could be tremendous opportunity not only in the energy sector, but also the materials sector, which is also really done lousy. I can remember a time 20 years ago where there was all kinds of commodities funds that were out there. Investing in rare earths and investing in, metals and materials. Well, you can't find many investment shops that provide a natural resources product out there nowadays, which is curious to me because I think about what's one of the biggest priorities of the current administration. We're talking about annexing Greenland, for God's sakes. Why? One, there's a national security argument that be made about it. The raw materials. If we're entering into a world of spheres of influence over the next the next generation or the next secular phase of spheres of influence, and you got to start making your own products, what do you need? You need raw materials. But those material stocks, including energy, 2 years ago they were trading at like 5 times earnings. And they picked up a little bit, but on a relative basis, they have been a non-performer for years because technology has sucked up all the oxygen. So there might be others that I missed.
So I like to think about things as far as like a chain reaction. If we need one thing, what things do we need to get that one thing? What I hear from a lot of interviews and things like that I listen to from CEOs in the tech sector and things like that is, there's a shortage of compute and there's a shortage of energy. What do we need for energy? What do we need for energy? We need electricity, right, for energy. How do we convert electricity? We need energy, things that into electricity. But we also need all the things that make up the energy sector, the electricity sector. What are all of the things? Copper, right? That's one thing. We need some rare earth materials that come into the things that make the compute. We also need some, all the things that go into designing all of the new infrastructure that we're going to need. So we've recently invested in some new companies that are in that area that I think have a long tail, kind of like to increase over the next several years. So anybody that's interested or whatever that wants to know, look in your portfolios. It's already in there, but you can ask me what it is, and I can discuss it with you. But yeah, I think a lot of things that haven't done well up until this point are so undervalued. Like I look at healthcare. Like, are you kidding me? Healthcare? Like people are getting older. We're not getting any younger. It's not like families are forming every day and like having like 4 or 5 kids. Like people are having like 1 kid, maybe 2 kids if we're lucky, right? So if anything it needs to be focused on, it's the healthcare industry, medical devices. As much as I hate to say it, like health and insurance and how that's going to look, and pharmaceuticals and all sorts of stuff. Like it's just insane to me to think that healthcare is down, like depending on what you're looking at, 30-40% this year, right? So it's pretty nuts. So those are my thoughts. Anybody else? Question? Go ahead. So let me reiterate the question for the audience at home when they watch the video. So we're an energy producer, right? We make tons of oil. Why are we spending so much money in another area where they make their own oil and stuff like that? Is that kind of like the gist of it? Okay, can I take this for a second, and then I'll lobby it back to you. It's a crazy thing to think that where California gets a lot of their fuel from is not from the U.S. It's strange, right? Like California is where Chevron was born, right? Like up until recently, that's where their headquarters was, and before they moved to Texas. But they have tons of oil fields there. Why are they importing fuel, right?
Standard Oil of California.
Standard Oil of California. That's right. The northeast part of the country as well, like Maine, Massachusetts, things like that. They're not getting their energy from the U.S. either. They're lacking pipelines to transport fuel and oil and natural gas up there. So it's not everywhere in the country that is actually able to use our own commodity that we produce here at home. Okay, so that's one thing. Also, I'd like to kind of like, and this is kind of odd, but in one sense, the longer that this goes on in Iran, the worse it is for the globe as a whole, right? Because there's a lot of disruption that's going on with, oil, natural gas, fertilizer, across the board. You'll see in the note that we put out, I think it's something like Japan. I want to say, I'm going off of memory, I think Japan is 90% reliant on the oil and energy that comes out of the Strait of Hormuz. I think it's India, that's 60%. I think it's China, it's 40%. And I think it's Europe is 20% for oil, 15% for natural gas, for liquid natural gas. Okay? A little bit. I think it's like 1 or 2%. It's not much. Yeah, it's like next to nothing. Okay. So it's a global problem. But at the same time, you know what else it is? It's not bad for the U.S., right? As a whole, it's not bad for the U.S. because what's one of the major things that the administration has been barking about over the last so many years? It's manufacturing, right? And we have to bring manufacturing back home. Who's our biggest manufacturing competitor? Say it out loud. China. Who's our second biggest? India. Okay? Right up there, right? Who do high oil prices hurt the most? China and India, right? Isn't that crazy? High oil prices globally actually, in a weird way, helps the U.S. hurts the rest of the globe. I'm not saying that that's right or wrong or fair or unfair. It's just, it is what it is, right? And because I keep thinking to myself, I'm like, what is this guy doing, right? It's a midterm election year. And I try and think of things as like completely apolitical, right? A person in power wants to stay in power. Across the board, whether you're Republican or Democrat, independent or not, person in power wants to stay in power. If the Democrats are in power, they want to stay in power. If the Republicans are in power, they want to stay in power. Okay, so right now you can argue the Republicans have control. There's a Republican president, there's a Republican House of Representatives, slightly, there's a Republican Senate, slightly, okay? So they have control. They would want to keep control. What the hell are you doing with this whole thing going on in Iran? Why are we there? You're messing up the midterm election year, okay? I don't know. Maybe it has to do with the fact that it just encourages people to keep manufacturing here. Maybe they're making better deals here at home than they are overseas now because energy is more expensive and they see how dependent they are on, not so stable countries. Yeah, and yeah, energy, oil as a whole is a commodity. It's a global commodity. So if oil prices go up in the Middle East, it's going to go up everywhere. If oil prices go up in Norway, where the Brent crude is priced out of, it's going to go up everywhere. That's just how it works. It's just they're going to shift money where it belongs to kind of, and everything goes up. Rising tide raises all boats, kind of thing. The other thing too is that if we're trying to create a way that there is more than just one or two superpowers, right? So since 1990s up until maybe 2005, 2010, when China really became like a global superpower, it was the U.S., right? Then it was the U.S. and China, right? If Iran becomes a stable force in the Middle East, it could really become the U.S., China, Iran, and possibly South America, right? Because now everybody is kind of dependent on everybody's success, for lack of a better word, okay? So I don't know if that's the aim or if that's not the aim, but that's just a kind of like counter argument of why we're sitting there for so long. Because otherwise I would think, like, what the heck are we doing there for so long? Why would they want to sit there for so long? Being the party in power, like, why haven't we seen more pushback? And that's just in my own thoughts, like how I explain that away in my own head. I don't know if that's right or wrong or not. What are your thoughts?
Yeah, I would just, to build on your points from an investment strategy perspective. One of the things that we saw since the beginning of 2025 is that we saw developed international and emerging market stocks start to perform really well relative to the U.S. up until the end of February. And since the end of February, they have struggled in developed international stocks, the United Kingdom, France, Germany, Japan, as well as emerging market stocks, think, Brazil, South Korea. They've struggled relative to the U.S., and it's primarily for the points that Ricardo just raised, is that a very critical input cost to drive the economic growth in these countries outside of the U.S. has become meaningfully more expensive, which hurts the profitability of the companies out of these areas of the world and makes the U.S. a relatively more attractive place to invest. So, from an asset allocation, from a portfolio management strategic perspective, it says, well, given this geopolitical outcome, U.S. looks more favorable than developed international emerging versus what we were seeing maybe 4 or 5 months ago. So now those are the types of dynamics that we're monitoring in our day-to-day work.
Yeah, and those are the questions that we have to ask ourselves every day, right? From being able to place capital to work, where do we want to do it? Do we want to stay at home? Do we want to go overseas? If we go overseas, do we want to go emerging markets? If we go emerging markets, where do we want to go in emerging markets? And we talk about some of these semiconductor companies like NVIDIA, like Micron, like Western Digital, Broadcom, all these companies. There's a decent amount of overseas semiconductor companies too. You have Samsung, right? They create semiconductor chips.
Taiwan Semiconductor.
Taiwan Semiconductors, they're the ones that basically make everybody's chips, and arguably they're the ones that are preventing this from becoming a bigger bubble than it possibly already is, right? Because they're the ones that basically manufacture everything. So something that maybe you guys don't understand, everybody's heard of NVIDIA, right? It's the most valuable company in the entire world right now, okay, right? They don't manufacture their own chips. All they do is design them, right? They design the chips. They have special software that they use, design it, and make all their little chips the way they want to make them. And then they send the design, all the blueprints to Taiwan Semiconductor for them to make it, right? So this company in Taiwan, they're the ones responsible for making all of the most high-powered chips in the entire world, right? They're the ones that are making everything. And because they lived through the 90s, right, and they remembered what happened, and they know the semiconductor boom bust cycle, which, by the way, up until 2023, 2024, a lot of these semiconductor companies, these memory chip companies that are now booming, were selling their chips at a loss, right? And not a lot of people realize that there was such a boom cycle during COVID for all the consumer electronics because of all the inflation that was going around, all the free money that was going around. Everybody was buying washing machines, cell phones, cars. There was such like a supply, crimp, because of all the manufacturing and everything, that people, and what typically happens during these cycles, companies that rely on those chips, well, they know that, Eric has a company, he's ordering chips. I need the chips more than he needs the chips. So if I want 100 chips, I'm going to order 200 chips because I want to make sure at least I get my 100, right? Kind of like the same thing that's going on right now with the SpaceX IPO. If it's 4 times oversubscribed, if I want 100 shares of SpaceX, I have to order 400 so I can make sure that I get my 100, right? And then all of a sudden we realize I got more chips than I need. I don't need any more chips, right? And it used to be that they only had to give them a promise of what they were going to buy that year, right? Okay, fine, I'll buy $5 billion worth of chips off of Eric over here. Now I have my $5 billion worth of chips. I'm not ordering chips for 3 more years. Well, Eric just manufactured chips thinking that I was going to need $5 billion worth of chips for the next 3-4 years, right? So now he has a glut of chips. And so now all of a sudden he's got to get rid of all these chips. So he's got a glut of chips. He's going to have to sell them at a discount. So it cost him $3 billion to create the chips. I promised him 5. He thought he was going to make a nice profit, but now he's got to sell them at 2, right? $2 billion. So he's losing money on the chips. Historically, that's what's happened with the chip market, right? Is it different this time? I don't know. We'll see. But going forward, the only time will tell that kind of thing.
And just to build on that too, from what Ricardo said, is that the chip prices that he talked about, a lot of the future revenue and profit forecasts from these AI companies are built around the same principle. You hear about tokens, for example, basically the access to, to this AI technology. And you have these companies that are building their future revenue and profit forecasts around the expectation that they can, sell this access to AI at, certain prices, $100,000, $10,000, $100,000. Well, what do we know from Econ 101 when you get an increase of supply of something where demand stays the same or starts to become less? What happens to prices?
Go down.
Prices go down. And you have all these companies that have these super high valuations built on future profit expectations. But as that marketplace becomes more well supplied and more efficient and able to produce at lower costs, well, if these companies start to not be able to meet these very ambitious forecasts, those are the types of things that cause AI stocks and AI-related stocks to go through those same boom-bust cycles that the chip stocks have historically gone through. That's a big danger for the tech sector going forward.
Next question. Let me just repeat the question. Let me correct me if I'm wrong here. How much has interest rates affected business development, mortgages, just the economy as a whole?
So, it's one of the things when we go to the store to buy things, we want to buy a washing machine, stop at the grocery store and pick up some food. The price for everything is measured in dollar signs. Buy a gallon of milk and $7 for a gallon of milk, or a carton of eggs. But when you go to the bank, the price tag for money is not in dollar signs, it's in the percentage sign. Basically, the interest rate that we borrow money from when we go to the money store or the bank, the price tag to buy money is the interest rate that we're paying on the loan that we get from the bank. And one of the things that I think has bred a tremendous amount of complacency in this economy, really going back since the bursting of the technology bubble, because we cut interest rates to like 1% in the aftermath of the bursting of the technology bubble. Interest rates were locked at 0% for years in the aftermath of the financial crisis. You could go to the money store and effectively get money for free. And if you want to grow your business, and if you have this like really cool idea, like, hey, I want to create an online bookstore that's going to sell everything for a loss for the next 20 years and put all these retailers out of business, or I want to make electronic cars that may not make money, but I get subsidies from the government because money is so cheap that I can get it for free. That's a great way to grow your business and to grow the value of your company in the stock market. Well, one of the things that changed in 2022 in the market, I would say the market's in overtime in its old ways of thinking at this point. We are now 4 to 5 years into a market environment today where money costs something now. And if the Fed's talking about raising interest rates going forward, chances are, and if we're entering into an environment where the path of least resistance is inflation, not deflation, the cost of money at the money store is going to start to become more and more expensive. And the more expensive it comes, the more corporate profit margins are squeezed, the harder it is to grow your business. And when we talked about stock valuations, that's when stock valuations start to matter. So that's going to be a big issue that we need to keep an eye on going forward. It's going to be a lot harder to grow your business likely over the next 10 to 15 years than it has been over the last 20 years.
So let's talk about rising interest rates for a second. So if we do have an inflation thing going on and the Federal Reserve does say, like, no matter what, Fed Chair Warsh wants to do, if the majority votes to increase interest rates, it is what it is. He can't stop it, right? So let's say it does go from 3.5, 3.75, which it is now, to, let's say, by the end of the year, it's at, say 3.75 to 4, right? Right now, priced into the market already knows, we can see this, that there's a greater chance of an increase in rates than not at this point between now and the end of the year. Is it that big of a deal? Like, does the market really care if the rates go up by 1/4 of a point or even, let's say, 1/2 a point? Because I think we're conditioned to remember what happened in 22, where we went from 0 to basically 5, then going from, say, if we had to go from 3.5 to 4.
Absolutely. If it's a situation where the Federal Reserve's raising interest rates, and let's just say they do 3/4 point hikes over the next 12 months, the market's prepared for that. It's a marginal change. And the biggest thing is expectations. I mean, that's what happened in 2022. One of the reasons, the market was down 26% over 10 months, and that was hard. But the market didn't think that interest rates were going to stay sustainably high. They didn't think that interest rates were going to be going to 9%. There was an expectation at some point after the inflation fire was put out that interest rates would come back down. And they have. It got up to 5.25% to 5.5% at the peak of the inflation cycle in 2022. We're now at 3.5% to 3.75% today. So if it's a situation we get a couple 1/4 point hikes, but then the market thinks, well, those rates will come back down in the next few years, the market can take that in stride. But if it's a situation where rates are going higher and the market starts to think, hey, they might have to keep going higher, then that might be tougher to digest. But the more likely right now the former as opposed to the latter.
Anything else?
Yeah, so, it's amazing with gold and with silver. Gold tried to get above $2,000 an ounce for like 15 years. In 2011, hit up towards $2,000 an ounce, couldn't break above it. And it wasn't until about a couple years ago it finally got above $2,000 an ounce, and then all of a sudden we're north of $5,000. Silver has spent since 1981 trying to get above $50 an ounce, and within a matter of 2 months, it was like $123 an ounce. The prices have come back down. We have gold that's, in about the 4,500 range. We got silver, it's around $70 an ounce. 62. So, but one of the things we've seen is what I refer to as a regression to the mean, is that the price explosion that we saw happen so far so fast, it's come back down, and it's basically come back into its longer-term trend line. So I'm actually, and this is my and don't want to trade off of this or anything like that, but I'm very constructive on the outlook for precious metals over the next 5 to 10 years. Only for the fact in terms of central bank demand, in terms of global alternative reserve currency in a spheres of influence world. That's true for gold. You mentioned silver has a dual identity. It's precious metal sometimes, it's an industrial metal other times. Both sides of the silver equation in terms of its industrial applications as well as its alternative precious metal characteristics. If history is any guide, we saw a similar environment from 2002 through 2011. You could reasonably expect both gold and silver prices to be meaningfully higher than in the future from where they are today. But I think what we've seen since January has been a regression to the mean. It's been kind of letting off some of the steam more than anything else. It's always tough with gold and silver because gold is volatile. It has the volatility of the S&P 500. And silver is anywhere between 6 to 8 times as volatile as gold is. So, timing entry points are tough, but if you use technical analysis, it can give you an idea of that. But it's,
I don't think you want to own gold for the sake of trying to make money in owning gold.
It's a good hedge.
If you want to own gold, you're owning it for the respect of is there a demand for it? Are there other countries buying it? Okay, I think today we can say that that's yes, especially as we get a little bit more segregated as spheres of influence, as you will, right? And also a hedge against stocks, cash, inflation, things like that. So that's how you want to play gold. It's not something that I'm going to buy gold today and try and sell it 6 months from now and make some money. Forget that noise.
It's a good long-term diversifier. Yeah. It is.
It's a different animal.
It's a totally different animal.
Yeah, different animal. It's like a leveraged gold play plus commodity play.
6x gold play with the volatility of commodities and you never know when the identity is going to flip. Well, you do raise a good point, and there is a good historical perspective to build on Ricardo's points about some of the volatility associated with gold and silver. With stock prices and bond prices, you have monetary policymakers and fiscal policymakers who have a strong incentive to make those prices, have interest rates be stable, and to make stock prices go up. There's nobody out there that's looking to defend the gold or silver prices. In the 2010s, there was some manipulation that took place in those marketplaces. And by the time regulatory intervention came place, a lot of money was lost. So that's another thing that's important to remember about gold and silver is that, there's nobody there that's going to defend it if the price is falling.
And one more thing, for me personally, and you can agree with me or disagree with me, to me, gold is just a hedge against the U.S. dollar. Dollar goes up, gold goes down, dollar goes down, gold goes up. I mean, people can say that it's an inflation hedge all day long. I don't buy that as much as just more of a supply-demand inverse of the U.S. dollar. So if you think that we're getting ready to walk away from the Iran conflict and we're getting ready to start, maybe printing more money or reducing rates or whatever, then you can think that at that same time, gold will probably go up. So that's kind of how I like to think of it. If you don't think that we're entering that kind of environment, then you wouldn't think that gold will go up. Maybe gold will stay flat or whatever. Gold is a completely different anomaly from all other metals.
That's the trick with commodities. Notoriously volatile, not for the faint of heart. So if you're worried about downside risk, they're very volatile. They all have their own unique characteristics. Whether you're talking about copper or sugar or cocoa, or they all have their own unique path they follow.
Yeah, copper is completely different from gold, completely different from silver. Gold is a precious metal. Copper is an industrial metal, completely different.
I want to thank Eric and Ricardo for putting on a expose of in-depth reading on our economy. I'm extremely thankful for you guys to be part of the Paragon team, that we have Eric as a resource for Ricardo, for Paragon, and for our clients here. I'm not sure when our next Finances on Tap is going to be, but we'll keep you posted. Thank you guys for taking the time out to attend. Hopefully it was helpful. Hopefully the food was good. Drinks are always delicious. And thank you to our panel.
And thank you, everybody.